Hello YouTube and welcome back to YFP, your final piece in your trading journey. So guys, in today's video, we'll be looking at same day externals on the asset class Euro USD, which will be the third part of the liquidity inducement series. So guys, if you haven't seen our previous videos, go back and watch them as they will go hand in hand with this video. And honestly, combining all of the liquidity locations that are provided you, so the internal range liquidity, your daily highs and your daily lows, and what we'll be covering today, the same day external, you will truly have an insight in towards how liquidity actually works and how to utilize this within your own trading. Now, this video is going to be sort of dedicated towards traders that are struggling with identifying the liquidity that price usually hunts on a daily basis, or they're following order flow on lower time frames like the M1 or the M5 and being stopped out and then price going and continuing in their intended direction, which is pretty frustrating, I know. And they probably haven't got a foundation or a understanding how the market makers actually cause breakouts to fake a trend and then reverse in the opposite direction. So guys, if these drawbacks do apply to you, then stick around and make sure you take enough notes, as I'll be showing you multiple examples of Euro USD, manipulating these structure points, the same day externals, to then reverse in the opposite direction. And I'll be touching upon a few of my own personal entry models that me and my community use. So let's get into the charts now, guys. Now, what you can see here is Euro USD. What we'll be breaking down is the previous 3 days of price from Monday. So Monday, Friday and Thursday. So I'm not cherry picking any sort of days and just showing you a random day that this has worked. It happens generally every single day in the market. You just have to have the understanding and have a few tips which I'll give you at the end of the video that I use personally to keep me right within these same day external trades. So breaking down this trade now, so we can see on the 5-minute time frame that price has hunted this Asia high, okay, in the London Frankfurt session, so Frankfurt London session. So if we go into the M1 and we go back to Thursday now, so just bear with me guys while I just find Thursday's PA. Okay, this is Friday. Okay, great, Thursday. So what we can see on M1 is price is in a range. So before I go into this, let me just explain this here for you so you sort of understand one of the entry models that I use with my community. So we have a range, price is hunted, buy side of that range, came back down, hunted sell side. However, there's no structure called liquidity here that sponsors this POI. So from this pullback, there's still a probability price could go higher. Therefore, we need to wait for extra confirmation that price has failed to create a new high, and then the imbalance that was created that pushed that leg up, there needs to also be an imbalance on the way back down. Okay, now we will play that by the balanced price range after price has broken the previous low and returned back into it, and that would be our entry. So now demonstrating this on price, we can see that we have a range. Okay, price is hunted buy side, it has then come back down into sell side. As I said, there's no structure called liquidity within this leg, it's just a straight drive down. So we have to wait for price to fail to create a new high, come down and break a low and return into the imbalance, and the imbalance that was created on the way back down and the way back up to fill in that balanced price range, and that would be our entry. Our stop loss needs to be above the high, and for our targets I will be touching upon the RR in the tips that will be in the last few minutes of the video. So make sure you have a pen and paper handy for that to just jot down the tips and the rules that I use for this model. Okay, so moving on to the second example now, guys. What can we see? Again, let me break down this this annotation before we get into the price, so you understand what we're looking for in this entry model. So we have a fake BOS, so price has created a low, lower high, lower low, and then a new high. Okay, so from this is classed as our fake BOS. Okay, and then from the fake BOS, we want to see the previous low being swept with a divergence. Okay, so what a divergence would be on the RSI. So if price has made a lower low here, essentially what we want to see is price failed to make a lower low on the divergence, and there is divergence. okay, and the RSI and price. So I'll be touching upon divergence in another video in depth, so you guys so you guys understand it a bit more. And also I will give you my personal script that I use for the RSI indicator, and my community use as well in future videos. Now, touching upon this example now then, so where is the fake BOS? Okay, so the fake BOS would be here. Right, now what we're waiting for is this low to be taken out, and we want to be confirming that with divergence. Okay, so as soon as we see that divergence in play, it sort of indicates that price has shifted and we have actually had a sweep that is not strong. It's not showing strength, as the divergence has made a higher low instead of a lower low. So we're basically stacking our confluences in our favor to take a buy. Okay, now to get into this trade, as soon as we see that divergence from this candle and then price prints this bullish candle, as soon as price prints that bullish candle, I am entering with my stops at the low. And again, my target is similar to the last trade, so 1 to 3, but stick around, I'll tell you why. So if you want, guys, take a picture, draw this out in your notebook. I would suggest you rewind the video and also draw out the previous model, as they're going to show up frequently within these same day external models that we're playing in. Now, moving on to the third and final example now then. Okay, so this was yesterday's price action on Monday. Okay, now this is one of the most highest probability entry models that I use, and it's the most frequent model that appears on price. So breaking it down, we can see that, okay, so generally, so you see chotch traders, flip traders, all of these sort of smart money that they think they're advanced, but generally they probably get stopped out more than basic SMC. But anyways, we have a high that has been taken out, okay, and then a low that has been taken out. Now, before the low gets taken out, you can see that price reacts to the last previous higher low, okay, fails to make a new higher high, and then breaks the previous low completely. Okay, now for the chotch traders and flip zone traders, this would be a POI that a lot of communities teach their students to take, and they literally would just get stopped out and price reverses in the opposite direction. Now, the reason for that is if we're thinking about early sellers and early buys, so let's just say as a trader, you have your POI marked out here, price is tapped into it, and then on this pullback, there is a fair value gap, there's an OB, and those early sellers have entered the market here. Now, as soon as price breaks that previous low, what do you think these traders are doing? They're going break even on their trades, right? So therefore, there's break even liquidity stops that are just here. So think about it. Any stops that are in the markets are going to be used in the opposite direction once they get taken out. Okay, so as soon as they get taken out, price goes in the intended direction. Now we call this the last high before the main high. Okay, so the last high before the main high is our liquidity point, so the flip is the trap. Okay, now looking at price action here, what can we see? So we can see a high to a high low to a high high. Okay, price breaks that high, comes back lower to break the higher low. All right, but before we broke the high low, what do we see, guys? Again, we see this flip zone. Okay, now what do you think happened here? X amount of sellers got involved again, hence why price gave the reaction. But what happens? They aggressively sweep price as a vector candle. So what a vector candle is essentially a aggressive candle that causes a displacement in the market, okay, and also is the same sort of speed in the way up as it is in the way down, okay, and it usually looks like an A shape or a V shape, okay, that's why it's called a vector. Now, again, as soon as price hits that liquidity point inside of the fair value gap, inside of the OB, whatever POI point of interest you have marked out, you will see a reversal take place, okay. Now again, guys, what is this RR? Okay, 1 to 3. So with all of these trades that I've shown you now, guys, there's a few tips that I want to sort of give you. So this is your chance to write down these tips, as these are the rules that I use personally to be able to find these sort of trades. So time is really important. So it's a very important factor for these same day externals. So if we're trading the London session, we need to be focused within an hour window of time between 6:30 a.m. and 7:30 a.m. for price to show us signs of a purge and revert. Okay. Now, if you're trading New York time, the range is in between 1:30 p.m. and 2:30 p.m. All of these times are UK GMT time. Okay. Now, in terms of trade management and risk to reward, so every single trade for the same day external model, based from our own data collection of around 50 trades, okay, I've found that it's best to take profits as soon as price reaches a 1 to 3. And that's because it's the sweet spot. So looking back on a few examples now, let me just show you the reason why. So looking back on this example here, okay, so previously, maybe a year or two ago, I would be actually focusing on targeting for my TPs at liquidity locations, okay? Now, by maturing as a trader, I understood that most of my trades would hit break even or a loss if I'm targeting these liquidity locations, and all of that profit that I've had on the table goes to waste. So how can I sort of utilize this in my advantage? It's just going back and analyzing previous data and understanding that all of the trades, or significantly most of the trades that I place using this model, hit a 1 to 3. Okay, now that is the reason that I take 3R full volume. Okay, so the three trades that I've just showed you, if you're just purely trading this same day external model, you've literally caught 3R here, 3R here, and 3R here. That's 9R, okay, in 3 trades. Now, there's a reason why I don't go for these high risk to reward trades anymore as well, is because I am a prop firm trader, okay? Now, being a prop firm trader, you need to understand that you're trading large amounts of capital. So you can be trading a 200k account, 1% risk on these trades. When they hit a 1 to 3, that's £6,000 return, okay? Now, 6, 12, 18,000 made in 3 trades. Whereas the trader that is catching or trying to catch these home runs, so these 1 to 10s, 1 to 20s, and showing you all of these hindsight charts, are they really profitable? You need to question this. Have they even had a payout from a prop firm? Question it. Have they even been funded with a prop firm? Okay, most of these people and influencers that you see that have communities are not even funded, guys. All right, it's like the blind leading the blind. That is why all of this data and all of this information that I'm giving you guys is truly valuable. You need to take this and take it with a pinch of salt, because for you to sort of utilize this within your own trading, you need to do your own research as well. You need to backtest all of these models that I'm talking about to see if you can actually interpret price the same way that I can through my lens. Okay, as soon as you can start doing that, you can then move on and focus on your psychology. And that leads me on to my next point. So I just want to read out a short paragraph from a book called The Best Loser Wins by Tom Hoggard. And he says that I truly believe that what separates the 1% from the 99% is how they think when they are in a trade, how they handle their emotions when they trade. That is not to say that there is no merit to learning the craft of chart reading. I know from my own experience that chart reading is an absolute must for decision making. But that is only a small part of the whole trading picture. Now, guys, sort of decrypting what Tom Hoggard is trying to suggest here is that once a trader has an edge, then their focus needs to shift on their psychology, because this is where the majority have a lack of. Now, you can do as much chart work as you like, but it all comes down to how you think in the moment and what you do to stop acting upon impulsive thoughts delivered by your monkey mind, okay? And you need to start using fear to your advantage and not your disadvantage. So I'm going to leave you guys on that note. Now, I hope you guys are enjoying the content so far. Please leave a like, as it will help the algorithm recognize me, and it will give me motivation to sort of make more content for you guys. And yeah, so in today's video, we've sort of broken down the same day external trades and how we can utilize this within our own trading. And I've showed you and demonstrated a few of my entry models that I use to enter these trades. Okay. Now, in future videos, I'll be going over lower time frame refinements in a bit more depth, and how multiple entry models can help you guys find the entry you are seeking without being an early buyer or an early seller. So stay tuned, guys. We are literally just getting warmed up. And if you want to join my free Discord, check the description box below. We'll have a link into the free Discord. And obviously, if you want to become a member of the paid community, hit me up on Instagram. There will also be a link in that, and I'll get you guys started with the team. As usual, guys, I'll catch you in the next video. Peace.